Alright, what's good to YouTube? I'm Tito, and today I'll be talking about penny stocks. Well, let's talk about what a stock is first. So a stock is essentially a share in a company. So say you like the company Apple, right? So you want to own part of Apple, but you're not the CEO, you feel me? So like you buy part of Apple and you make money off of it if Apple does well. So essentially what a penny stock is a small company. Like Apple's a big company, take a small company and invest in it. And the return can be like the money you make, like the profit can be like a lot. So a penny stock is any share under $5. So let's check, I don't know, Tesla's shares right now, see how much they're worth. So Tesla right now is worth $802 per share. So if you didn't have $802, then you can't invest in Tesla, sorry. So like what penny stocks do basically is allow you to take a little bit of money and turn it into a lot of money. So you can buy multiple shares of a penny stock, right? So say if a penny stock is worth 50 cents, 2 shares of that penny stock, right, is $1. 2 shares of that penny stock is $1 for you to buy, right? So let's say this company does good, they release some news, they have a good product, they're a solid company, right? Their stock rises to $1. Now you take your 50-cent shares, right? So you were in at 50 cents. The stock has now risen to $1. So your money just doubled. Why? Because the stock is now worth $1. So you got in at 50 cents. Your growth is 100%. So your growth is 100% because it doubled. Now, usually this is not the case. Your money just won't usually double unless you really do your research and find a good company. So let's say you get 20% return. So you buy a stock for $1, right? And you get 20% return of that. You now take $1 and cut it into fifths. That's 20 cents. So now you just made 20 cents off getting in at $1. So basically the investment strategy is trying to get in at that low point, try to get that growth so you can actually like make money. There's different types of terminology. So basically when a stock is bearish, that means it's going down. So you can see on this chart there's a downward trend. So a trend is basically just where it's been going. On different apps they have different like charting like sites. You can use Thinkorswim, you can use the apps like Webull or Robinhood. These are all different investment apps. I personally use Robinhood because it's simple. We'll get to the trends in a second. So first you need to download Robinhood, or an investment app so you can follow along. To make a Robinhood account, you do have to be 18 or sign under someone who's 18. Robinhood is just a place you can trade stocks or penny stocks or anything, any type of share. So use my referral link in the description down below to get a free stock. Also use my Webull referral link to get a free stock. Because if you sign up for Robinhood, you just might as well download Webull as well, because it'll give you free money, literally free money, like a free stock. It's just giving you free money from that company. Go ahead, download my freaking link thingy down in the description. Get yourself a free stock on Robinhood. So now back to the trends. So a downward trend is something that goes down for a period of time, right? So the opposite would be an upward trend. Then that means the stock is bullish. Not bullish, bullish means the stock is going up, right? My stock be going up like a crescendo. You know, Drake is the best rapper of all time. No, I'm just fine. But so like a bullish stock would be showing upward trend, right? So what I invest in are biotech companies, right? Because these are usually cheap companies. They're usually penny stocks. And usually if you get in good news, like if you get in on a dip, or if you just invest in it and they have good news, you can literally return your money double. Like the best penny stock I've had was about 50% return. So that means I put in about $100 in the stock, right? 50% return is literally take 50% of what you put in and add that to your money. So now I came up on $50, right? By putting $100 in. Now if you put more money in, say if you put $1,000 in, 1,000 times 0.50, that's a $500 come up. So if you put 1,000 into a company and the return is 50%, then you get $500. Then you can add that, reinvest that into a different stock. Now, this is what makes it hard, is how long you should hold it for, because stocks don't always go up. Sometimes they go down, sometimes they stay stagnant or stay the same. So it really comes down to how you want to trade. So like, one of my methods is I look at the FDA calendar, look at what biotech companies are coming out with news, see how much how much I want to put into them. A lot is like the size, the amount of money, because you need money in the stock market to make money. Unfortunately, you need at least something. Like, it's not like free money. So like, say I see this really good company, right? Put $100 in them, right? Wait like a week to see, and they get approved, like, or the hype, like either the hype from the company trying to get approved will move the stock market up, or the approval itself, or the earnings of a company, how much a company made, like they're profitable, if they're not profitable, then that could all move the stock. The stock is just people, like, all together, just like hype trading. So like, that's how you make money off of it. You have to time the market. So basically, say I buy a biotech company share. I buy like 100 shares, and that's like $200, right? And they get some bad news, right? So if I'm down 10% on the share, so say after a week they're not doing well and I'm down 10%, right? So I could choose to hold that, never take it out, like just wait till it goes back up to my $200 is saved. That might not always happen. It depends. You just have to look at the charts, see the analysts. Sometimes the charts are even wrong. Like, you can't predict everything. Like, you really just have to do an educated guess and try to see like what the stock is going to do. Most likely, if you analyze it right, the trend is upwards. It's not going to just go down, like, unless the stock has like been going down for a while. So back to my $200, right? I'm down 10% on it, right? So I lost $20. So now I have $180. I could take that and invest into some different companies that I think will do better, or I could just hold it, wait for it to go back up. If it doesn't go back up, just sell it a lot. So that's the basics of holding and trading stocks. Like, really, all you're doing is buying and selling, buying and selling, buying and selling, taking your profit, putting it back into the company, buying and selling, buying and selling. Now, once you take your profit, you have a bigger lot size. So say you made $5 off of a stock, right? You take your $5, right? Now add it to your $100 that you started with, whatever you started with. Now you've increased your lot size by $5. So whatever that 100, say you get 10% return off 100, right? So now you have $10 if you only had 100. But if you add your $5 profit that you made off a different stock, right? Take 10% of 50 cents. It's not much, but something. Now your 105 turns into $10.50 when you get 10% return. Now, I'm not saying you're guaranteed to get return on any company you invest in. You have to do research. So usually what I do is like check the trends, right? Check the charts, check the company's history, check their CEO, check their earnings. Have they met earnings? Like, there's 4 quarters where they have to get earnings, and like if they don't hit the earnings, stock usually goes down. If they smash the earnings, do above, stock usually goes up, right? Usually. So like, really, the stock market is unpredictable. You can't predict it. It's an educated guess. So usually this is why you want to buy when the stock is down. So there's overbought and oversold. So I'll give you an example. So say, since we're using Tesla, use Tesla for an example. So say Elon Musk comes out with a new car, right? Everybody's excited about this new car. Stock is going up like a crescendo, right? Stock is $800. Now it's $2,000, right? So the people who have it on $2,000, they're like, wait, I made a huge profit. I'm gonna sell this, right? That means it's overbought. Now that's an overbought stock, right? Because all the people who got it for $2,000 all their like, they're like, what the hell, I just made $1,200. So they start selling their stock, right? It starts going down, right? It starts dipping. Now that's when you cross the threshold into oversold. So say everybody starts selling Tesla like hot, like, right? So once Tesla dips to like, I don't know, it's at 800 right now. Say it dips to like 600. Now Tesla's oversold. That's the stocks you want to buy. So when you see a stock is oversold, that means it's gonna adjust, because the market's always doing this, right? So say Tesla goes to like $600, then everybody's like, Tesla's worth $800. So people start buying more of it. The stock goes back up. The stock is like based on people trading it. So like all the people who got it at 2,000 are now losing money. So that's why you never want to buy. Usually there's cases where you can buy at the top, it'll keep going up. That's when a company's really solid. But if a company you know is like not worth $2,000 a share, then it's gonna start dropping. Like Tesla is not worth $2,000 a share. So if it goes up to $2,000 a share and you buy it at $2,000 a share, you will most likely lose money, because now it's being oversold because all the people are taking their profit, right? So when you buy that oversold stock, you wait for it to go up. If it keeps dipping, eventually it'll go up some. Now it's how much it goes up is depending on you want to invest into it or not. So that's what I usually do. I try to see which stocks are oversold, which penny stocks are oversold, because then people will come back to the stock and bring it up. So usually there's two types of trades. There's day trade and swing trading. Swing trading is when you buy something, you hold it for a period of time. So you just don't sell it in the same day, which is a day trade. Day trade is like getting profit fast. You're buying it and you're selling it in the same day. Swing trade, you just hold it out, get your profit, sell it the next day, 2 days. That's a swing trade, like you're swinging from bar to bar, right? So those are the basics of penny stocks. Penny stocks are very risky. You can lose your money. You're not going to lose all your money, but you can lose some money. But you can also gain a lot of money. So it's really a fun place to invest your money. And I also recommend you have some long-term investments that just keep your stock going up. Some solid companies that you know will not fall, and eventually you can just profit off dividends, which is companies paying you for investing in their company. So like if you have a strong stock, you just leave it there, leave your money there, leave $50 there for a year, right? Their stock goes up 10%. You just made $5 by doing nothing. So it's really just making good educated guesses when it comes to penny stocks. So yeah, that's about it for this video. If you guys do want to see more penny stock videos, or me do like a challenge or something like that, like where I go grow an $100 account, see how many swing trades I can get, grow a $500 account, I don't know, you guys name it down in the comments down below. But yeah, if you guys want to see more penny stock videos, give this video a thumbs up, or just more investing videos in general. Remember to download Robinhood or Webull, or both if you can, with my referral link, and it'll give you a free stock to get started trading, right? So you do have to be 18 or sign up under somebody who's 18. But yeah, hope you guys enjoyed this video. Comment down below for more suggestions, and I'll catch y'all later. Peace.